Hello, students. Let's continue with your module 3 of export finance that we have. So far, we have spoken about the various types of loans that are given. We spoke about pre-shipment and post-shipment finance. We also spoke about the counter trading that can happen, that is the trade for trade kind of a thing. And we also spoke about the concept of letter of credit, which is undertaken on a large scale basis, especially at the time of payment of the exporter when he has to deliver the goods and services. And this is the last part of your module 3, where we will be talking about various banks or financial institutions who offer the assistance and the helping hand to the exporter to have a good trading without any flaws. So the very first, what we spoke last time was all about the commercial bank, and now we will be talking about the role of Exim Bank of India. So basically, after realizing the importance of export trade and also after knowing the role played by various exporters in the international market, there was a high need to have a separate bank to carry out the international trading. So whenever we talk about international trade, there is the foreign exchange which is involved into it, foreign payment that we have to make it and all. So for that, we need to have a separate bank who will be able to take care of it. So we have the Exim Bank, which is Exim is basically the short form. Exim stands for Export Import Bank of India. Okay, so it is basically to carry out the export and import all over the world. So in this particular topic, we will not touch the import part of it. We are just going to talk and see that in what way the Exim Bank will assist the exporter to carry out the trade smoothly. So the Export and Import Bank of India, which is commonly known as Exim Bank, was set up in the year 1st January 1982. Again, not many a times, but एक हाथ दो बार पूछा गया है. Exim Bank was set up in the year or on dash, 1st January 1982. So what were the objectives that were kept in their mind before coming up with the Exim Bank? The very primary objective was to translate the national trade policies into the action phase. So whatever was planned, whatever policy was been framed, need to have some kind of practicality, need to adopt the action-based kind of a thing. So that was been taken care of it. Second objective was to provide alternate financial solution to the exporter and the importer. Further, to responsible to export problems of Indian exporters. Needless to say, there are a lot of challenges that the exporter may face when they are dealing in the international trade. And to avoid that, to guide them well, to help them, to assist them, to give them prior knowledge that what all are the problems that they can expect, that they can deal with. So based on that, they need to sort it out. They can be intimated it beforehand. They means the Exim Bank can take some efforts to intimate the Indian exporters. Further, to initiate and participate in debates on issues central to India's international trade. So many a time, if there are any kind of debates or issues that they have faced, they have, come up with it, or if there are kind of discussions that we need to do in terms of money at an international level. So for all this, we have the Exim Bank who can play a leading role, who can initiate and participate into it. And there are many objectives, but again, I have shortlisted it based on your explanation or based on our topic. The last objective is to develop mutually beneficial relationship with international financial institutions. So Exim Bank again plays a very crucial role to develop a good rapport, good relations with other banks and other financial institutions who are dealing in the finance area, and especially to benefit both the parties that are involved into it, so that we can have the win-win situation at both the ends. this is all about the introduction part of it. Now we are going ahead to the actual part of role of Exim Bank. This is what you need to understand. And even into the exams, you can make this into a tabular column, and then one by one you can start explaining them. So we have the way we had divided the commercial banks role. In the same way, we have divided the role of an Exim Bank into the fund-based assistance and non-fund-based assistance that we have. So when you talk about fund-based, it is categorized into Indian parties and Indian banks. That means if the exporter wants to have money, so for them they can assist. And also the Indian banks, overseas buyers and overseas bank. Further, I'll explain you. Let me just tell you about non-fund-based also. Non-fund based is categorized into financial guarantees, advisories, and other services. So now let's see one by one the pointer that we have. So the very first one is fund-based assistance means assistance to the Indian exporter. So what kind of an assistance that they will provide? It provides financial assistance to a deferred credit export. I hope you all remember in the very first slide, we spoke about a deferred payment. That means when I'll give you the same example. If we have taken a contract to build up a bridge, or you start to build up the metro train completely, and to building up a metro train, not less than 12 to 15 crores that we'll be needing it. But obviously, no matter whatever loan that you take, it cannot be fulfilled quickly, and when it's a huge loan, you need to have a huge bank or a proper formalized bank who can give you that much of loan. So whenever you talk about deferred credit or deferred export, it is all about giving the loan on the huge amount of money that is involved into it. Further, it offers credit facilities also to the deemed exporters that we have. So deemed exporters के लिए credit facility मतलब overdraft या और on loan वगैरह देना है, that can also be given. It finances Indian joint venture in foreign currencies that we have. So in case if the exporter has some kind of tie-ups with other companies in other countries, so for that also they are ready to give the loan to the exporter. Finances units in SEZ, that is Special Economic Zone, and 100% EOUs, that is 100% export-oriented units. For them also, they are ready to finance it finance it by the Exim Bank that we have. Apart from that, the Exim Bank will also provide the pre-shipment finance to the exporter for procuring raw materials and other inputs which are necessary for the manufacturing of machinery and equipment that is to be exported. If finances export-import of machinery and equipment on the lease basis also. So even if we wanted anything on rental basis or lease basis, we can easily get the loan, we can get the money from the Exim Bank. It provides computer software exporter foreign exchange loan subject to RBI clearance. Exim Bank also provides finance facility against deferred credit to the exporter of consultancy, technology, and other services. Exim Bank also provides finance to the Indian exporters to undertake various export marketing activities in India and abroad through export marketing funds. Exim Bank also operates an export development fund to finance techno-economic survey research or any other study for the development of the Indian exporters that we have. So this is how all the assistance, all the help that has been provided by the Exim Bank to the exporter. Though I have read out around 5 to 6 pointers, you may just write it in your own words around 2 to 3 points that we have. So that is all about the exporter. So now let's talk about what help that Exim Bank will provide to the Indian banks that we have. So Indian banks, we just spoke about commercial banks in the last audio. So commercial bank exporter ko deta hai, but tomorrow if commercial banks need money, so whom are they going to ask to? So commercial bank can take a loan from the Exim Bank, and then they can further give it to the other people or other exporters that we have. So what do they do? The Exim Bank provides refinance facility because the direct loan nahi. Commercial bank, Exim Bank se loan lega, and then further they'll give it to the loan to the exporter. Therefore, the word used is the refinance. वो वापस पैसा दे रहे हैं, right? So refinance facility so as to enable the commercial banks to offer credit to Indian exporter who extend the term credit to the importers. Further, the Exim Bank also offers export bill rediscounting facility to commercial banks in India who have earlier discounted bills of exporters. So these are the two assistance or help that has been provided by the Exim Bank to the other commercial banks that we have. Now there is a question when you talk about overseas buyers and overseas banks. That means basically the importers को भी loan देता है Exim Bank and importers के bank को भी loan देता है. So now the question arises: why will the Exim Bank of our country will take effort to make the payment or to give the loan to the importers? There is only two things or 2 pointers behind that, because once an Exim Bank gives the loan to the importer, directly, indirectly, they are encouraging, they are, promoting the importer to purchase it from the Indian exporters. Okay, that's one thing. And when they are giving a loan to the importer, in near future, the importer has to return back that loan, and along with the loan, they also need to return back the interest onto it. So it is a win-win situation in both the ways. मतलब loan and interest भी मिल रहा है and अपने exporters से भी वो लोग खरीद रहे हैं. And with that, this two intention, with this two objectives, Exim Bank is happily giving loan to the importers and also to the banks. Okay. So what is the assistance to the overseas buyers? It offers the credit facility to foreign importers for importing of Indian capital goods and related services with repayment spread over a period of years. Further, not only to the importers, but also to the banks they are ready to give. So long-term finance is also provided under lines of credit to financial institution abroad, who in turn extend finance to importers of their country to buy Indian capital goods. It provides a relending facility to overseas banks to make available term finance to their client for import of Indian goods that we have. So more or less same ही है. Only thing buyers we talk from the importer's perspective, and to the bank we talk it from the banker's perspective that we have. So that is all about the fund-based assistance that has been provided by the Exim Bank. Now let's talk about non-fund based assistance. The very first one is the financial guarantees that has been provided by the Exim Bank. So Exim Bank provides non-fund based assistance in the form of guarantees such as bid bond guarantee, performance guarantee, etc. These guarantees are provided together with the commercial banks that we have. Advisory and other services. It advises Indian companies in executing contracts abroad and on sources of overseas financing. It advises Indian exporters on global exchange control practices. And the Exim Bank also offers financial and advisory services to Indian construction projects which abroad. It advises small-scale manufacturers on the export market and product area. It provides access to the Euro financing sources and global credit sources to Indian exports. It assists the exporter under the forfeiting scheme as well. So that was the role of Exim Bank that they perform in the international trade. So again, this is how it can be a full-fledged 7.5 marks per question that can be asked to you into your exam. Now let's talk about the role of SIDBI, that is Small Industrial Development Bank of India. Earlier, it was only IDBI, Industrial Development Bank of India. But then later on, once when they realized that the small scale sector is booming, small traders, or maybe even for that matter, family owned businessmen have started developing a good amount of business in the rural areas and all. So with that intention, they came up with the concept, came up with the idea of having a SIDBI, that is Small Industrial Development Bank of India, and to assist the MSME sectors to grow and get the good amount of funds. So SIDBI was set up on 2nd April 1990 under an Act of Indian Parliament, Presently, it acts as a principal financial institution for the promotion, financing, and development of the micro, small, and medium enterprises sector, and also coordinates the functions of the institutions engaged in similar activities. SIDBI has its head office in Lucknow, that is UP, and has a network of 15 regional offices and about 31 branch offices in India. So what are the functions of SIDBI? This is how I have categorized it, though it looks very much colorful, but it's very easy to understand if you understand the concept and write it. So we have categorized the role of SIDBI in 3 ways. The very first one is refinance assistance that has been provided by the SIDBI. Second one, okay, under refinance, we have seed capital scheme, equipment refinance scheme, and tourism related finance scheme. Further, second category that we have made is schemes of direct assistance. That means directly SIDBI को approach करना है, अपना project या proposal रखना है, and if they found to be feasible, worthy, then they will surely give you the loan. Further, and under that schemes of direct assistance, we have project finance scheme, we have ISO 9000 scheme, and equipment finance scheme. Further, for the bills scheme, we have direct discounting scheme, DDS, which is commonly called as, and we also have bill rediscounting scheme, that is BRS. Okay, so let's understand one by one what is it. So the very first one, when you talk about refinance assistance, so that is the assistance which is refinance. For example, there are financial institutions like SFC, that is Small Financial Corporation, and they also have something called as SIDC, Small Industrial Development Corporation. So these are the very small financial institutions who provide the loan to the MSMEs, especially for them to grow or promote about their products, market their products and all. So ये सबके लिए जो पैसा लगता है, the exporters can contact SFCs and get the loan. And SFCs को जब पैसा चाहिए रहता है, that time they will coordinate with SIDBI or they'll ask it to the SIDBI. So that is what is the indirect way to get the loan from SIDBI. Okay. So the very first one is seed capital scheme. Okay. So why this name or how the name seed capital came into existence? So what do we mean by the seed? It is a very small, we can say bean kind of a thing, which we sow it into the ground, into the mud. And then when we water it, we nourish it, it grows into a tree. Same way, when you have to have a new startup, when you want to have your own new setup, so you need to gather the funds, you need to convert those funds into the equipments or other physical resources. You need to have a land. For that you need a money to purchase it, or if you can rent out for some particular place and all. So to meet up your basic needs to start up your business, you need money, you need capital. That is what is called as seed capital scheme. Okay, so you get that money from the SFCs or SIDC, and that can be like a loan. And once when you have a complete setup and when you start running out with your business, you can slowly and steadily repay back to the SFCs that we have. Further, the second one that talks all about the equipment refinance scheme. I think if you read it correctly and if you understand, it is self-explanatory for that matter. We have a complete setup, but there are chances that in between, to expand your business or to modify or to have a new upgraded technology into your business, you may have to purchase some kind of equipment, some kind of machinery to make the show run successful. And with that intention, we need to have equipment refinance scheme. So the third one is tourism related scheme. Yeah, this is a new scheme and the new area that they are touching upon. The travel and tourism is a sector which is growing like anything. And there are certain countries, we talk about Thailand, Malaysia. These are the countries who are attracting or who are minting money, huge amount of money only by attracting the tourists for that matter. Okay, so I'm not saying which is wrong, but tourism has become, or travel and tourism has become, a new service sector altogether to generate a good amount of money. So how are we going to attract the tourists? By creating some new tourist places. So a very common example from our Indian point of view, if you take, you talk about this Statue of Unity. So a lot of people criticize, a lot of people talk good about it. But if you think from this tourist angle, it has become one of the greatest plus point, and it has attracted the attention of a lot of people. And that has also generated a good amount of employment. So to see that Statue of Unity, a lot of people come to this place. So to make or to build up that Statue of Unity, again, it is such a tall one that you cannot reach there. Even if you put a ladder, you will not be able to reach to that height. So even if they want to put the flags or worship, they have to go it by the helicopter. So to build up such a huge statue, they need to spend a good amount of money. So कहाँ से आएगा ये पैसा? Again, they can take a loan from the SFCs and SIDC, or they can directly approach SIDBI. And under this tourism-related finance scheme, what will they get? They will get some kind of concessions in the interest rate. So जब loan ले रहे हो, around 8%, 9%, or even for that matter 10% तक का interest rate उनको pay करना पड़ता है. So when you take a loan for the tourism purpose, you may get some kind of concessions on the scheme, concessions on the loan that you'll be taking it. So that is what is all about the refinance assistance. So these are the three categories, three types that you have under refinance. Second one, if you are a huge exporter, renowned one, and you have already undertaken a lot of export trade earlier as well, you as an exporter can directly talk to SIDBI to get the financial assistance from the SIDBI bank that we have. So the very first assistance that they'll get it is all about the project finance scheme. If you have a new project in your mind, if you have a complete blueprint of it, if you have it's all a plan readily available for it, you can propose it, you can explain them, you can tell them the benefits for yourself, for the exporter, for the country, for the nation, for the society. And if they are convinced with it, and if they really feel that it will go well into the market and it will fetch a good amount of profit, because only if you fetch the profit, only if you as an exporter get the profit, you will be able to repay back the loan to the exporter that we have, right? You will be able to repay back the loan to the banks, right? So you earning or you proving that you're going to earn the profit also plays a very important role from repaying angle that they have. So presenting your project and getting the finance. Second one is ISO 9000 scheme. So for that, you need to understand what is ISO first of all. ISO stands for International Organization for Standardization. So what is the role of ISO? It is basically the quality assurance scheme that we have. So if you have that ISO recognized or ISO certified, it is an assurance given to the customers that you provide the quality goods, quality services to your consumers. No one can counter question or counter attack on the quality part of yours. No, see, if you are the exporter, you will obviously blow your own trumpet, or you'll talk good about your products and services. But when the ISO firm, it's a huge, it has its headquarters in Switzerland, but obviously they have given a lot of rights and, the liberty to other small ISO firms or, quality assurance companies who can come to your company. They can verify how you're functioning, how you're performing. And if they found everything to be correct, everything to be good, they can issue you the ISO certificate. So now here the question arises, ISO में पैसा का कहाँ involvement है? So let me tell you, to get the training done or to modify the things as per their requirement, they have all kind of policies and processes and documentation to be done. So वो सब करने के लिए again a huge amount of money is involved into it. A lot of things are to be modified. The way of working is to be modified, So this is how the ISO 9000 scheme purchase करने के लिए या adopt करने के लिए the funds can be or the loan can be taken from SIDBI. Then we have equipment finance scheme. It is same like this only, equipment refinance की तरह ही है. Only differences equipment refinance में it is the loan taken from SFCs and later it has been repaid from the SIDBI to SFC. Whereas equipment finance scheme में the exporter can directly approach SIDBI and asking for a loan so that they can perform or they can purchase equipment and they can perform well. Further, we have is bills scheme. Okay. So what do we mean by bill scheme? It is direct discounting scheme. So SIDBI directly discounts the bill of exchange drawn by MSCs that we have. In that also they have two types, GDS equipment, wherein the bills are normally for 5 years and minimum transaction is of value rupees 1 lakh. Whereas when you talk about DDS components, where unexpired period is not more than 90 days that we have. Further, bill rediscounting scheme, SIDBI also rediscounts the bills that were earlier discounted by the commercial banks. There are two types of bill rediscounting scheme. BRS equipment, that is where the usance of bills is normally for 5 years, and BRS, which is for the short-term period, which is for not more than 90 days that we have. So that is what is the role of SIDBI. You can explain all these 8 pointers briefly. You can first write this in a table format and then you can explain it one by one. So this is where we have completed with role of SIDBI as well. Now let's move on to the last topic of this particular chapter, that is the role of ECGC. Now class, to be very honest, I'll advise you, though I am going to make audio on it, but I'll advise you don't go very much in detail about it because it's a very huge topic and then there are a lot of figures and data involved into it. Again, from the examination point of view, although it is very much important, कभी-कभार नहीं, मतलब साल में एक बार या 2 साल में एक बार क्वेश्चन जरूर पूछा जाता है. But again, I'll tell you, just to take some 50-80% का risk के लिए ये पूरा डिटेल में पढ़ने से अच्छा, just understand briefly what is ECGC and that is more than enough for you all to write it for the objective oriented questions that we have. Okay? So I'll just tell you what all kind of an objective oriented question that they can ask. The very first one is, what is the full form of ECGC? So ECGC stands for Export Credit Guarantee Corporation of India. Okay? It is a completely government owned company. मतलब government based है, कोई private firm नहीं है. What is their objective? Their objective is to protect, listen to me very carefully, their objective is to protect the exporter and the financial institution from the political and commercial risk that is involved into their trading. Political and commercial risk जो होता है उसको protect करने का काम ये ECGC करता है. So now the question arises, what is commercial risk? Commercial risk is a risk that is connected to the importer. That means importer का IC license जो है, IC code number है, उसका validity खत्म हो जाता है, या the importer becomes bankrupt, या importer is not able to make the payment, whatever. So these are the risks which are associated with the importer. That is what is called as your commercial risk. Okay. What is political risk? Political risk is all about the risk which is associated with the country. Okay. Something like there is a war kind of a situation and the new policies are established by the government stating that we are not going to deal with so and so company, so and so country. So importer is ready to purchase your product. They are liking your product. The financial stability of the importer is also very good. But the government has come up with a new rule which says completely, strictly no to purchase any kind of goods from so and so country. So ये commercial risk क्या होता है ये भी बता दिया, because they may ask you commercial risk is a risk arise by dash importer. Political risk arises due to dash, it arises due to um, any of the importers country that we, you know, that is all about the role of ECGC, well, the introduction of ECGC. Now let's understand in detail what is its role and how far they are able to protect them. So, what all are the policies or issues which have been covered under ECGC? There are four issues or the four groups in which it has been broadly divided. The very first one is the standard policies. Standard policies are issued to the exporters to protect them against payment risk involved in exports or on short-term credit basis. Then we have specific policies which are designed to protect Indian firms against payment risk involved in exports on deferred terms of payment, services rendered to foreign parties, and also the construction work and turnkey projects undertaken by the abroad. The third group, the third category that we have is financial guarantee, which is issued to banks in India to protect them from risk of loss involved in their extending financial support to exporters at pre-shipment and post-shipment stages. And the last category that we have is special schemes such as transfer guarantee meant to protect banks which add confirmation to letters of credit opened by foreign banks, insurance cover to buyer's credit, etc. So we are going to talk about all these four categories in detail. Okay. So the very first category that we have is standard policy. So the standard policy is issued in case of consumer goods which are sold on credit, not exceeding 180 days. It is a whole turnover policy. All shipments are covered under one policy for a period of 180 days. ECGC has designed four types of standard policies to provide cover for shipments made on short-term credit. The first one is Shipment Comprehensive Risk Policy. This is mainly to cover both political and commercial risk from the date of shipment. Further, Shipment Political Risk Policy. This is to cover only political risk from the date of shipment. Then the third one is Contract Comprehensive Risk Policy. This is to cover both commercial and political risk from the date of contract. And lastly, that we have is Contract Political Risk Policy to cover only political risk from the date of contract. So risks covered under the standard policies are commercial risk and political risk, which I have already discussed and I have already told you. Risk which is not covered under standard policies, there has to be categorized about what is not covered under standard policies. The first one is commercial disputes, including quality disputes raised by the buyer unless the exporter obtains a degree from a competent court of law in the buyer's country in his favor. Second is causes inherent in the nature of the goods. Buyer's failure to obtain import or exchange authorization from authorities in his country. Next one is insolvency or default of any agent of the exporter or of the collecting bank. Next one is loss or damage to goods, which can be covered by commercial insurance. Next one is about the exchange fluctuation. And lastly, if there are any kind of discrepancies with respect to the documents. Under all such categories, your standard policy will not be applicable. Second part is all about, or the second category is all about the specific policies. What are specific policies? The standard policy is a wholesome turnover policy designed to provide a continuing insurance for the regular flow of exporter shipment of raw material, consumer goods, and consumer durables for which credit period does not normally exceed 180 days. Contracts for export of capital goods or turnkey projects or construction works or rendering services abroad are not of a repetitive nature. Such transactions are therefore insured by ECGC on a case-to-case basis under specific policies. So specific policies are issued in respect of supply contracts, service abroad, and construction works abroad. So specific policy of supply contracts is issued in case of export of capital goods sold on deferred credit. It can be any of the four forms. That is, specific shipment comprehensive risk policy to cover both commercial and political risk at the post-shipment stage. Specific shipment political risk policy to cover only political risk after shipment stage or shipment date. Specific contract comprehensive risk policy to cover political and commercial risk after contract date. And specific contract political policy to cover only political risk after contract date. So these policies, like standard policies, cover 90% of the loss on account of commercial and political risk that is involved. The second category under specific policy is service policy. Indian firms provide a wide range of services like technical or professional services, hiring or leasing to foreign parties. Where Indian firms render such services, they would be exposed to payment risk similar to those involved in export of goods. Such risks are covered by ECGC under this policy. If the service contract is with overseas government, then specific services policy can be obtained. And if the services contract is with the overseas parties, then specific services policy can be obtained, especially those contracts which are not supported by bank guarantees. Normally, cover is issued on a case-to-case basis. The policy covers 90% of the loss suffered. The third one is construction works policy. This policy covers civil construction jobs as well as turnkey projects involving supplies and services. This policy covers construction contracts both with private and foreign government. This policy covers 85% of loss suffered on account of contracts with government agencies and 75% of loss suffered on account of construction contracts with private parties. The third category that we have is all about the financial guarantees. So the exporters require adequate finance support from banks to carry out their export contracts. ECGC backs the lending program of banks by issuing financial guarantees. The guarantees protect the banks from losses on account of non-repayment of loans by exporters. The ECGC charges a premium for its services, which may vary from 5 paise to 7.5 paise per month for ₹100. The premium charge depends upon the type of guarantee and it is subject to change if ECGC so desires. So the very first one in this we have is packing credit guarantee. Any loan given to the exporter for the manufacturing, processing, purchasing, or packing of the goods meant for export against a firm order or LC qualifies for this guarantee. Pre-shipment advances given by banks to firms who enter contracts for exports of services or for construction works abroad to meet preliminary expenses are also eligible for cover under this guarantee. ECGC pays 2/3 of the loss. Whole turnover packing credit guarantee. This is a variation of packing credit guarantee. This guarantee is issued to banks which undertake to obtain cover for packing credit advances granted to all its customers on an all India basis. In this case, the risk cover is 75%. Export production finance guarantee. This guarantee enables banks to provide finance at pre-shipment stage to full the extent of the domestic cost of production and subject to certain guidelines. The guarantee under the scheme covers some specified products such as textile, woolen carpets, ready-made garments, etc. The loss covered is 2/3. Then we have the third one is export finance guarantee. This guarantee covers post-shipment advances granted by banks to exporters against export incentives received, such as duty drawback. In case the exporter does not repay the loan, then the bank suffers loss. The loss insured is up to 3/4 or 75%. Then we have the fourth one is post-shipment export credit guarantee. Post-shipment finance given to the exporter by banks through purchase or discounting of export bill qualifies for this guarantee. Before extending such guarantee, the ECGC may ensure that the exporter has obtained the shipment or contract risk policy. The loss covered under this guarantee is 75%. Further, we have the last or the second last one that we have is export performance guarantee. Exporters are often called upon to execute bid bonds supported by a bank guarantee, and if the contract is secured by the exporter, then he has to furnish a bank guarantee to a foreign parties to ensure due performance or against advance payment or in lieu of retention money. An export proposition may be frustrated if the exporter's bank is unwilling to issue the guarantee. This guarantee protects the bank against 75% of the losses that it may suffer on account of guarantee given by it on behalf of exporter. Export finance guarantee. If a bank financing an overseas project provides a foreign currency loan to the contractor, it can protect itself from the risk of non-payment by the contractor by obtaining this guarantee. The loss covered under this policy is to the extent of 75% to 90% depending upon the premium rate. And the last category that we have is special schemes. Apart from providing policies and guarantees, CBC also provides certain special schemes. These schemes are provided to the banks and the exporter. So the very first scheme that we have is transfer guarantee. It is mainly to provide the it is guarantee provided to safeguard banks in India against losses arising out of risk of confirmation of letter of credit. The risk can either be political or commercial or both. Loss due to political risk is covered up to 90% and due to commercial is covered up to 75%. Insurance covered for buyer's credit and the lines of credit. Financial institutions in India have started direct lending to buyers or financial institutions in developing countries for importing machinery and equipment from India. This sort of financing facilities immediate payment to exporter and frees them from the problem of credit management. ECGC has introduced this scheme to protect financial institutions in India which extend export credit to overseas buyer or institutions. Oversees the investment insurance. With the increasing exports of capital goods and turnkey projects from India, the involvement of exporters in capital participation in overseas projects has assumed the importance. ECGC has evolved this scheme to provide protection for such investment. Normally, the insurance cover is for 15 years. Exchange fluctuation risk cover. This scheme provides protection to exporters of capital goods, civil engineering contractors, and consultants who have to receive payment over a period of years for their services, where such payments are to be in foreign currency. They are open to exchange fluctuation risk as the forward exchange market does not provide cover for such. So that is all about your ECGC. Though it's a very lengthy one, but And that is how, as I said, if you can even skip it, that is fair enough. But you need to remember its objectives oriented questions that we have. So this is where we can wind up with our module 3. This is where we have completed with our module 3 as well. And we have completed with first 3 modules that we have. So module 3 basically focused all about the finance part of it, the loan that the exporter takes it, the role of various financial institutions that we have spoken. And we have also discussed about what all are the methodologies or ways in which the payment that can be made in the international market. So that is what is all about the financial responsibilities that an exporter needs to take. And lastly, we touched upon the part of your ECG, so that is Export Credit Guarantee Corporation of India. So that was all about your module 3 of export finance. Next time when we meet, I'll come up with the last module, that is the export documentation and procedure and documentation that we need to speak upon. Till that time, bye-bye.